Hello again, everyone, and thanks for joining the third quarter 2020 market review. As always, we like to start with a balanced perspective. With COVID-19 still unresolved from a health standpoint, it's pretty evident that that's going to be the major driver towards a full economic recovery. The sooner we can get a vaccine that the world has faith in and that can be distributed in mass quantities, the quicker we can get back to normal, even if it's a new normal. But in the meantime, the financial media has a way of throwing uh, evidence of optimism and evidence of pessimism our way. And we just want to make sure we digest both and take a balanced approach. So, on one hand, we do see some positive signals in that certain countries around the world have been able to get the virus a little bit more under control. And in those situations, their economies have picked up. And that's maybe a little bit of foreshadowing for what we can expect on a global scale once we can really get this pandemic under control across the globe. Another positive note is that we've learned better ways of treating the virus. The death rate has come down. We now know that putting people on ventilators isn't always the best course of action, whereas in the beginning, there were a lot of sort of uncertainties about the way to treat the people with the disease. So I think that's a reason for optimism that we'll continue to get better at treating the illness in addition to getting closer to a vaccine. Now, on the opposite side, the reasons for concern, or more so just uncertainty, um, partially surrounds this upcoming election. We all recognize that markets tend to get volatile around election time, so we probably should expect some of that. But on a more serious note related to elections and politics is whether or not the government will agree on a stimulus package. And that's denoted there as wondering whether we have some more fiscal aid coming, especially when you consider that monetary policy may have reached, sort of the end of the line. Maybe the Fed doesn't have all of its tools in its toolbox anymore. So potentially, fiscal relief is really what's needed to get us through the remainder of this downturn. Also, within our investment portfolios, we recognize that the low bond yields, which constitute a pretty good chunk of many investors' portfolios, presents us with challenges. So we have to question, do we take additional risk to get additional expected return, or do we accept the lower yielding securities because they serve a different purpose in the portfolio, in particular, treasury bonds serving as a hedge against any potential stock market decline. So we'll talk about that a little bit later. Just wanted to mention up front what some of the challenges are that are facing us going forward. So let's start with a little bit of a conversation around the election. It's clear that there are some investors out there who, almost regardless of their investing experience, still believe that one party or another would be better for the stock market. The 24-hour news outlets, which seem to be migrating to diametrically opposed ends of the political spectrum, is certainly partially to blame. Nonetheless, if an investor only had invested money in the market under presidents of one party or the other, their results would have been very disappointing. This graph shows you the value, or I should say growth, of a $10,000 investment starting in 1961 if you invest only under one party president or another, and then compare that to staying invested the whole time. On the left, you see a $10,000 investment that is only in play when a Republican is in the White House, would have generated a total terminal value of $86,000 from 1961 to 2019. If you only invested under a Democratic president, you would have achieved a little bit better rate of return of 376,000, but both of those numbers pale in comparison to the $3.2 million that you would have in your account if you just stayed invested the whole time. That seems unfathomable, but it does show the power of compound returns, and it shows the difficulty of trying to time markets, and it also shows you the detriment of being uninvested for large periods of time or even short periods of time. To break this down into further detail, this slide shows you the rate of return of the S&P 500 under each presidential term going all the way back to Herbert Hoover. Bars pointed to the left indicate a negative return for that term, and bars pointed to the right indicate a presidential term with positive S&P 500 returns. So as you can see that going all the way back to the Great Depression, there have only been 4 presidential terms with negative returns for large US companies. The first 2, down towards the bottom of the page, were in and just after the Great Depression, which was a pretty tumultuous economic time. We can also look at what was happening in the world under the 2 Bush eras near the top of the page that you saw negative returns for, the first of which was right after the dot-com bubble, and certainly we recognize that 9/11 occurred during that presidential term. And then towards the end of the second Bush term was when we started with the Great Recession. So pretty unique times, and really we want to just point out that there's really no justified reason for suggesting that the stock market would be at risk under any political party or individual president. So let's take a little closer look at how we are doing in our economic recovery. And what we're looking at here is data for various components of our economy. The top line, the blue one here, shows you essentially mortgage applications for new home purchases. And then we see some data around consumer consumption, and then some data for industries that have been particularly hit by the pandemic. So we see that in the beginning of the year, most economic activity took a bit of a nosedive, some more than others. Mortgage origination declined, but not quite as much as restaurant dining and airport travel, which you see, basically falling off almost entirely. So since that period of time, and as the virus has been somewhat more understood, if not better contained, we've seen a little bit of the start of a recovery, but in some sectors, the recovery has been more intact than others. So we would say that home purchases, judging from the blue line, are now at a higher rate of growth than they were a year ago, versus these other categories that are still in decline relative to a year ago. So consumption data is coming in that the consumer is coming back, still not back to where we were a year ago, but getting better. These other categories, restaurant dining, airplane travel, that sort of thing, had a little bit of a growth spurt during the middle of the year, but then the momentum seems to have faded. So we have a long way to go, especially when it comes to these industries bringing jobs back. We know that a lot of these industries have more lower paying jobs, and we need to recognize that lower income households tend to spend a greater proportion of their income. So these households truly are the growth engine for our economy. So this is partially why the Fed has spent so much attention lately on getting employment back and less attention on inflation, which we'll talk about in a little bit. But first, let's talk a little bit about the fixed income markets. Fixed income is just another word for bonds. And if we focus on the third quarter, there was a bit of an uptick in optimism for a continued rebound and eventual vaccine. Over the last few months, we've gotten better news that many of the companies that are working on vaccines are getting closer and closer. But over that period of optimism, investors' appetite for risk showed up in slightly higher returns for corporate bonds over that period. And that's reflected by this orange line showing short-term corporate bonds up about 1.1%, and the light blue bar showing intermediate-term corporate bonds up about 1.9%. As we'll talk about later, and I just mentioned briefly, the market's inflation expectation has also been ticking a little bit higher, resulting in relatively decent returns for inflation-protected securities, and that's reflected by this gray bar showing the short-term inflation-protected bond index. Over longer periods of time, all kinds of bonds have turned in decent results as investors have sought safe haven investments and also have been reaching for yield. In particular, you see this 9.9% return for intermediate term treasury bonds. And when you consider that when investors are seeking safety, they usually flow from more risky securities into treasury bonds, and that boosts their underlying price. One feature of bonds that should be understood by investors is that when their prices go up, their yield goes down. And this stands to reason, especially when you consider that another name for the bond category is fixed income. In other words, if I have a bond paying a fixed coupon of $5, but its price is at $100, then its yield is 5%. But if the price goes from 100 to 120, my payment still stays at $5, but my yield going forward is now closer to 4%. And anybody that wants to buy that bond from me at $120 is now getting a 4% yield. The graph that you're looking at here shows the result of that relationship over the last few years. The rising values discussed on the last page and the trend over the past decade or so have put us in a position of very low bond yields today, which is essentially what we can expect from these securities going forward. And that's illustrated by the solid line represented by September 30th, 2020. Now, this being said, it may raise the question of whether it's worth it to hold these securities at such low yields. And we think that it is because treasury bonds are the security in the portfolio that is most likely to protect us in the event of a stock market decline. And remember, that's partially why we have bonds in the portfolio in the first place. So we like to include this chart about inflation, but in this case, we'll talk about it in the context of that low yielding bond market. One of the reasons why low yields in bonds shouldn't necessarily be scary or something we should, totally disregard from our portfolio is because inflation is so low. If bonds were yielding 1% and inflation was 4%, we'd be losing a lot more in terms of purchasing power. But as this slide shows, specifically at the right side of the page, inflation has been low and steady for quite some time, and the global slowdown has further dampened it. If you look at the inset, specifically the top two lines under the August 2020 column, you could see that headline or core CPI, which is the consumer price index, is under 2%. And the only difference between the two is whether or not you include food and energy prices or not, which tend to be more volatile and tend to drive these numbers. But either one that you use, you see that inflation is very low. In fact, it's lower than the Fed's target rate of 2%. So it is much more palatable to have lower yielding investments or lower returning investments if you're losing less purchasing power because of inflation. Now, that being said, on a go forward basis, there has been a little bit of an increase in expected inflation. Partially, this is because the Federal Reserve eliminated their 2% target inflation priority and replaced it with a policy in which they're going to try to keep inflation at an average of 2%, meaning if we're operating at let's just say we're operating at a 1% inflation rate for 3 years, that means the Fed might be inclined to let inflation run at 3% for 3 years so that it averages out to 2%. So removing that mandate of the Fed to keep inflation at 2% serves to give some market participants at least a little bit of prediction, let's say, that inflation may tick up or be able to rise going forward. So now let's get to the topic that everyone generally prefers to talk about, and that is the stock market. During the third quarter, the S&P 500 returned to its pre-pandemic peak. The red line shows how many days it took to go from peak to bear market trough back to peak. And you see that it was a mere 126 trading days. The next fastest recovery on record was back in the 60s when it took over a year. Yes, it says 310 days, but those are trading days. Those are days that the market is open. So if you look at the date range there, you see that it took from February of 66 to May of 67 to get back to its pre-bear market peak. So that's astounding. The most important takeaway, I would say, is who would have predicted this? If someone told you back in February that in October we'll still be wearing masks, not going to movie theaters, and the President of the United States will have COVID, would your guess be that we would have rebounded that fast? Probably not. And that just tells you how difficult it is to predict market activity. Instead, if you simply have a disciplined strategy to allocate your portfolio in accordance with your goals and risk tolerance, and then simply rebalance when those relationships get out of whack, then you have a disciplined way of buying low, essentially buying on the dips and rebalancing out after your investments have been successful. So you trim your profits and continue to rebalance your portfolio back to target, and do that in a systematic and disciplined way, not try to predict what's going to happen next. Unfortunately, there's a dark underbelly of the recovery story in the stock market. We often talk about the market, and I put that in air quotes, or the S&P 500, as if it is one homogeneous thing. But this year's experience makes it very clear that it's not. What you're looking at are rates of return from the beginning of the year through the end of August. And on the left, you see that the S&P 500 was up about 10%. The S&P 500 is widely regarded as a market benchmark that, is a great way to assess how the market is doing, but it still only considers 500 US companies, and they are among the 500 largest companies in the market. So it is still just a subset of the market. Okay, the S&P 500 was up 10% through August. The top 5 stocks alone, the middle bar, you see were up almost 50%, while the remaining 495 stocks in the S&P 500 were negative. Those top 5 stocks in the middle of the page are Apple, Microsoft, Amazon, Facebook, and Google, Google's parent, Alphabet, I should say, which constitute 22% of the S&P 500. If you think about this pandemic, or the global slowdown or shutdown, if you will, you can realize that there are good reasons why these companies have done well. Amazon helps people buy what they need to buy when they can't leave their house. Microsoft and Apple provide technology that allow households and businesses to keep functioning. Facebook and Google keep people connected with the outside world when they can't necessarily connect in person. So there's good reasons why these companies did well, but it's important to point out that they're pretty much the only companies that have done well. There's certainly some other pockets out there, but these 5 companies, and if you add Netflix, then it's even a bigger differential. But the point is that, unless you had a significant portion of your portfolio in these 5 stocks, then the S&P 500 really isn't a good representation of your portfolio. If you have small company stocks that aren't even represented in the S&P, if you have non-US stocks that most well-diversified portfolios should have, let me say all good diversified portfolios should have, then that's going to diminish the rate of return of your portfolio and make it look less like it performed more poorly than the S&P 500. And we just wanted to point that out. Now, a more common or familiar way to break down stock market returns is by the size of the company, large, mid, and small, or whether they exhibit characteristics of a value or a growth stock. And as a refresher, a value stock is one that is trading at a discount to some metric of its underlying value. Some folks use their company's earnings rates, and that would be a valuation metric like the PE ratio, or price to earnings ratio. Others use the book value of a company's underlying assets, and that would be something like, it would be called the price to book ratio, and there are many others. A growth stock is one that investors would buy almost regardless of its valuation or regardless of its current price, because they think that the stock has a promising future to continue to grow its earnings. Historically, value stocks have outperformed growth stocks. And also, I mentioned the size of companies. Historically, smaller companies have outperformed large companies, but that hasn't been the case recently. And when you consider that the companies that we talked about that have been driving the market, the Microsofts and Apples, et cetera, you know, they fit squarely into the large cap growth category that you see by these silver bars that have really been the only game in town over the last 12 months, and to be honest, over the last few years. So that said, we don't want to give up on the strategies that, you know, I shouldn't say the strategies, but we don't want to give up on other categories of stocks just to chase the hot part of the market. We want to maintain diversification. We recognize that there are these periods of cyclicality. And again, we want to almost always own everything. And when parts of our portfolio outperform, we trim that part of the portfolio and rebalance into what's not been working as well. If we turn outside the US, the quarter was positive, as shown on the left side of the screen, especially for smaller companies and emerging market stocks. Year to date, the middle columns, the numbers are down, mainly because outside the US, there aren't those technology companies like those that have driven domestic returns higher. As we start to close out our presentation, we'd like to talk a little bit about diversification. What you're looking at is a lot of data for sure, but the way to read it is that each column represents a calendar year, and each block represents a different asset class or different investment category. They're oriented with the best performing category for that year at the top and the worst performer for the year at the bottom. I want to call your attention to the right side of the page, and in particular, look for the blue blocks, which represent large US stocks. If you look at the right side of the page, for the last decade or so, you see that large cap US stocks have occupied the top half of this grid. But we want to make sure we don't let the recent past cloud our judgment going forward or lead us to believe that large US companies will always be ahead of the pack. If you look towards the left side of the page, you can actually see a span of years between 2002 and 2012. That's 11 years where non-US large cap stocks, which are reflected by the beige block, developed ex-US equity, actually outperformed US large cap stocks 8 out of those 11 years. So again, we understand that recently US large cap stocks have been the best game in town, but we don't suggest using recent past to make investment decisions. We definitely discourage chasing the hot category. If you've tuned into these quarterly calls before, then this slide should look familiar. We like to close out each presentation with a reminder to focus on what matters and focus on what you can control. All 7 of these bullet points are important to keep in mind at all times, but the third one from the bottom seems appropriate to highlight today. This is where we remind you that a broadly diversified global portfolio is the most prudent approach. It's also where we remind you about the importance of asset allocation. Choosing the ratio of stocks to bonds and cash in your portfolio is going to be the #1 determinant of your long-term performance. Trying to time the market or trying to figure out which part of the market is going to outperform going forward is a difficult, if not impossible, task to do consistently. Thank you for your time today. We certainly appreciate the trust you place in us as your advisor. Feel free to reach out with any comments, questions, or suggestions you might have about this presentation or anything in any of the work that we do for you.